A recurring theme in the recovery after the global financial crisis has been the promise of policy support to limit downside risks. Now, most of the work is being done by global central banks because, of course, fiscal strains mean that there's not much you can do in terms of tax cuts or spending increases. That continues to be the case. Now, we have a desynchronized global cycle at the moment, so naturally policy is going to diverge, but there's a consistent theme that policy is asymmetric in its approach. That means the central banks are much more worried about downside risks, more worried about deflation, than they are about the risk of staying too loose for too long. We continue to see evidence of that. European Central Bank is preparing to loosen policy again in December, despite the recovery we're seeing there. China continues to loosen policy, even though credit growth is still very rapid indeed, and that helps us to limit the downside risks. Okay, so the Fed is probably going to be raising rates in December, but they've already waited a lot longer than you could reasonably expect, and it shouldn't be disruptive to markets or to the recovery when that finally happens. So overall, we think this policy support is a really important part of safeguarding the global recovery, reassuring markets, and it helps us to have a very benign view on the outlook for the global economy.
Since early August, when risk assets were undergoing a steep decline, we highlighted, based on our analysis, that this was a correction, not the start of a bear market. Indeed, this call has played out nicely in the month of October. After falling some 13% in August and September, the World Equity Index rebounded sharply by 10% in October. The US stock market led in this recovery and is now back to the level prior to the fallout. The asset classes of high yield and emerging market bonds also recovered strongly alongside equities. Now, where do we go from here? We believe the global monetary policy environment remains conducive despite the likely Fed rate hike in December. The European Central Bank has signaled for more quantitative easing. The Bank of Japan is under pressure to do more to combat deflation. And China, having cut rates for the sixth time this year, is expected to also do more to support growth. As a result, total G3 central bank balance sheets, a measure of global liquidity, will continue to grow into 2016, thus supporting equities and high-yield bonds. Capital outflows from emerging market bonds are showing signs of bottoming. Given the attractive yield spreads over developed market and government bonds, capturing the prevailing 5 to 6% yield is achievable through a diversified portfolio of well-researched credits, whilst targeting an overall portfolio credit rating of BB. Potential tailwinds of policy in Europe and Japan augur well for their stock markets. US stocks have been solid on the back of Q3 earnings, and with the best growth prospects among developed economies, we want to stay engaged in US equities through a neutral weighting. We prefer developed market over Asian equities. Previous market cycles have shown that Asian stocks are more exposed to US rate hikes, and so we will revisit our view on Asian stocks post the likely rate hike in December.